You just landed a massive contract. It's the breakthrough your business needed. But there's a catch. Your client's payment terms are net 90. That means you do the work today, pay your staff today, buy materials today, but you don't see a dime for 3 months. In the business world, this is called the growth trap. You're profitable on paper, but you're broke in the bank. Today, I'm going to show you a tool that fixes this instantly without you taking on a single dollar of traditional debt. It's called Invoice Factoring. Let's break down how it works and if it's right for you. At its simplest, invoice factoring is selling your unpaid invoices to a third party at a tiny discount. Think of it like this. You have a $10,000 invoice. Usually you wait 60 days for it. With factoring, you sell that invoice to a company called a factor. They give you about 80% to 90% of that money immediately, usually within 24 hours. They keep a small fee, and once your customer pays the invoice, the factor sends you the remaining balance. This is the key part. This is not a loan. You aren't borrowing money. You're selling an asset, your accounts receivable. That means no monthly interest payments and no new debt on your balance sheet. Step 1, you provide your service or product to your customer and send them the invoice. Step 2, you send a copy of that invoice to the factoring company. Step 3, the factor verifies the invoice and wires the advance, for example, $8,500 on a $10,000 invoice, to your bank account. Step 4, your customer pays the factor directly when the 60 or 90 days are up. Step 5, the factor sends you the reserve, the remaining $1,500 minus their fee. Now, what does this cost? Typically, factors charge between 1% and 5% per month that the invoice remains unpaid. But here is the pro tip you need to know. Ask if the deal is recourse or non-recourse. Recourse factoring means if your customer never pays, you have to buy the invoice back. Non-recourse means the factor takes the hit if the customer goes bust. Non-recourse is safer for you, but it costs more. If you're a startup with no credit history but you have big, reliable clients like Walmart or the government, factoring is a goldmine. It lets you scale as fast as you can sell. However, if your profit margins are paper thin, say under 5%, the factoring fee might eat all your profit. Conclusion: factoring is the bridge between the work you do today and the life you want to live tomorrow. If this helped you understand your cash flow better, hit that like button and subscribe. I've put a link in the description to a factoring fee calculator so you can see the math for yourself. See you in the next one.